Welcome to Remarkable Retail Podcast, Season 6, Episode 2, presented by Marketile. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, wonderful to see you and break bread together, amongst other things, in the Big Apple at the Big NRF show. A special treat for me as well to share the stage with you, talking about the Remarkable Container Store.
Yeah, I'm still recovering. It was exhausting, fast-paced, inspiring, et cetera, et cetera. So, but yeah, it was a lot of fun. Definitely a lot of fun, and I feel like the people are back into full conference mode at this point.
For the audience listening, we're not going to talk much on this episode today about the NRF show. We've got a whole dedicated bonus episode coming up in a few days, Friday, if you're listening to these in sequence, where we'll share our thoughts. And while we were at the NRF show, in addition to being on the stage, we did some fantastic interviews. And you and I were just talking off mic about how blessed we were to have such great content coming up for our listeners.
We're going to have to figure out exactly how to sequence those among some other things we're working on. But yeah, stay tuned over the next couple of months for some really rich discussions.
This might be the first time we're together, you and I, in person 2023, but it's certainly not the last. We'll be podcasting at Shop Talk in Vegas and then at the World Retail Congress Barcelona. And I think you're speaking at least 2 or more of those, and then one more. Have I got that straight?
Yeah, I'll be on the stage at Shop Talk in Vegas. I guess that's the end of March. Then the World Retail Congress in Barcelona at the end of April. And then, this is a little bit weird, I'll be back in Barcelona just a couple weeks after that for Shop Talk Europe, where I'll be moderating a session. So more details on that over the coming weeks.
This episode is the second of our 2 2023 prediction episodes, the back half plus a few baker's dozen wags, as the industry calls them, wild ass guesses, to wrap up the predictions. So before we get to that, though, let's get to the latest retail news. All right, so everybody's on pins and needles, so to speak, trying to figure out how holiday was. We've got some numbers coming out from the US Census Bureau, which gives you good US numbers. What think you of the numbers you've seen so far?
Well, we got a couple things. Yeah, the US Census Bureau monthly report came out for December. And I guess 2 things really from it. One is that clearly there are even further signs that sales growth is moderating. If you look at kind of the trajectory of the month over month reports throughout the year, pretty much the increases keep decreasing. So flattening curve, but sales were still up year over year, close to 6%. If you assume we are closer to 6% now with inflation, that's pretty much flat activity. So that's not awesome. The other data point we have is that the National Retail Federation put out their holiday sales. So this is sales for November and December. And their estimates were that that sales grew just over 5% year over year. Their forecast had been 6 to 8%. So again, perhaps keeping up or barely keeping up with inflation. I think we're just getting a lot of signs that the post-Thanksgiving period was a lot weaker. We'll talk about a couple other examples of that in a second, but a lot weaker than people were forecasting. Online and non-store sales, which is really kind of mail order catalog and a few other miscellaneous things, did show improved growth rates, almost 10% year-over-year increase. And then one other just data point that's not specific to the holiday per se is that NPD reported that discretionary retail spending for the entire year fell by 2%. That doesn't quite line up with some of the other data, so I'm not sure exactly
what
why
do you think's
that
in that
is.
number? Like, I guess obviously food would not be in that number, but if my freezer breaks, I need a freezer. It's no longer discretionary. How do you think they compile that number?
That's a good question. I don't know all the component pieces. It is a wider definition than the NRF and the Census Bureau number. I do know that. So I do think there are some spending at retail establishments that are more service oriented, for example, that are in that number. So it is a wider definition, but yeah, it doesn't quite line up. On the one hand, it's not all that surprising because 2021 was an unusually high year for spending. So this, if you look at it on a longer term trend, it's not necessarily way out of whack. But anyway, generally, continuing signs that things are slowing down. Similarly with inflation, we did see some moderation in some other reports we got across the last week. Most of the moderation was driven by gas prices going down. Right. But food prices continue, even though they're getting better, they continue to be one of the big drivers of inflation. And, maybe some of the interest rate hikes are starting to really take hold. We should mention that in a couple weeks, instead of the two of us, the amateur economists speaking, we will have Ira Kalish, the chief economist for Deloitte, on. We recorded that great episode earlier this week, and we'll dig into some of this stuff in a little bit more detail. And I think that'll be not only really interesting, but I think really helpful perspective for us as we move forward into 2023.
Well, as they say, when you look at all these numbers, retail is detail. And as everyone has slightly different definitions, it's very important to pay attention to what they're talking. Core retail, discretionary retail, year over year, month over month, all these different things. Very important to not get that, brushed over and look at the big numbers. What do you think of this Nordstrom news? They seem to say, as I was reading through their release, they say we cleaned out some inventory, took some hit in margin, we're ready for 2023. Is that your interpretation of how their performance?
That might be a little bit of spin from their perspective. What we're talking about is because Nordstrom's not reporting their earnings until I think March 3rd, maybe something like that. But they did gave an early perspective on where they expect to be for the quarter, which was largely around pretty weak holiday performance. They basically said that they expect sales to be down. The sales are the underperformance in sales largely driven by especially weak performance in the Nordstrom Rack division. That's their off-price division. Mm-hmm. They generally said that the real higher end part of their business was pretty good, but the more price-sensitive part of their business was not very good. And they expected, to your point about getting their inventories in shape, they expected to take some pretty good margin hits to move through that merchandise. So yes, they may, on one hand, they may be going into the spring in a much better inventory position, so they won't be needing to mark down as much stuff. But this kind of sales performance on top of not great results across the last couple of years, I think is concerning. I will mention really quickly, I was in the Nordstrom Rack, a couple of Rack stores over the last few weeks, and they do not look good. I'm very unimpressed by
like disheveled
their
or just not well stocked.
Disheveled, lots of merchandise, not very shoppable. Lighting levels not great. I mean, it doesn't really feel like they've put much money into those stores. And trying to be a discount oriented concept, I'm not expecting it to look like a full line store. But here in Dallas, one of the Nordstrom Rack stores is right next door to a Saks off Fifth store. And there's a Bloomingdale's outlet right across from it. And I was in all three stores, and very big difference in terms of the merchandise presentation and the shoppability. So I think from an execution standpoint, they got some real work to do there. I'm not saying that's the source of all their issues, but that's definitely really been a challenging area for them, I think, going on 3 or 4 years now.
And it is troubling because strategically they always position the Rack in, amongst other things, as the new customer generator, right? Bring in younger customers, get them used to Nordstrom through the Rack, and then upgrade them, so to speak. When people's lives, when people get more established. So it's concerning that if you're not successful in Rack, it is one leg of the stool that's not driving in new customers. So it is a bigger issue than just not hitting a sales number on a particular week. Look, let's talk about layoffs. Every day, it seems the big tech folks are taking it in the teeth in terms of making layoff announcements. So, what have you read? What have you read this week?
Well, just in the last couple of days, we got announcement of very large layoffs at Microsoft and Alphabet, the parent company of Google. Smaller numbers at Wayfair, which seems to be really, really struggling. We won't hear from them on their earnings for a while, but I don't think this bodes well. And I'll come back to Amazon in a second. But, on the one hand, when you see, 10,000 layoffs, 15,000 layoffs, that seems very concerning. I have seen some people point out that as a percent of the workforce, it's a pretty small percentage, and that if you actually look at how many, because this is, I think, really the source of the issue is not so much that their businesses are falling apart. It's really that they expected that they would need a lot more people. Yeah. And then, so if you actually looked at their employee growth over time, this kind of gets them back on the trend they were on, 2019, 2020. And it was really that they overshot the runway. But nevertheless, obviously, this is affecting a lot of people, and there will be ripple effects, I'm sure, on the economy. Amazon, which we had previously talked about because they were rumored to be doing a bunch of layoffs, they apparently started these layoffs this week. And there was an article I saw that had pulled messages off of the Slack channel from Amazon where people were sending them screenshots. So you can kind of get a sense of where some of the layoffs were occurring. Not details around the numbers, but it definitely seems like, as had been previously suggested, that a lot of the layoffs were occurring really outside of AWS and advertising in the retail area, in voice commerce, even in Just Walk Out. So as we talked about a little bit already, like what this actually means strategically for them going forward, I guess remains to be seen. But as far as letting the spending kind of run wild, I think it's pretty clear those days are over. They also announced that they cut this, it's called their Smile program. I don't know if many people are familiar with this, but it's where they take a portion of the referral or the affiliate marketing fees they get, and you can designate them for charity. And they are cutting that program. Probably not a huge cost savings in the scheme of things, but I did see a couple articles saying that in the years they've had this program, they've redirected funds, about $500 million in funds to charitable organizations.
That's turning a frown upside down. That's I
see what you did there. Yeah,
see what you did there. Well, my one quick comment on that is, all these layoffs, I've said before, and I'll say it again, are actually good news for retail, because this retail, there's tens of thousands, if not 100,000 jobs in retail technology that are left unfilled. And, it's a hard transition. It's not always like for like, but there's a lot of retailers looking for a lot of skilled people that could be coming out of, Microsoft, Alphabet, Wayfair, wherever, right? So,
sure, remains to be seen whether it will stay this way. But, we have seen other layoffs, large layoffs be announced across the last several months. And yet here in the U.S. anyway, the unemployment rate has actually gone down. Right. So it certainly seems like the vast majority of people, to your point, not necessarily one-to-one, but lots of people are able to get employed quite quickly. So hopefully
these
that
tech
will be
guys
the case.
grab the headline. These tech guys grab the headline, but I think it's a bit of jazz hands in terms of I think it has an outsized influence on the way we think about the performance of the economy. Anyway,
absolutely.
What else should we talk about? So food prices continue to grow, and they will this year. That's for sure. Let's talk about Rent the Runway. So interesting news. They've opened their own online storefront on Amazon. Is Amazon now the distributor, the central distributor, master distributor for brands now? Is this how it works?
Well, maybe the distributor of last resort. Folks aren't familiar. We've talked about Rent the Runway, which is really, after a nice run, has really struggled the last couple of years, both in terms of their stock price and earnings and management changes and layoffs and things like that. Like a couple of other businesses, Gap, for example, not too long ago, Peloton, that had a different distribution model. They're now supplementing their distribution with their own online business and some stores to have a storefront on Amazon. So, I assume these moves are driven by getting more awareness for the brand, being where obviously lots of traffic goes. So, hopefully it's incremental and, changing the equation, taking a shorter margin, presumably, to sell on Amazon, but not having all the other related marketing and distribution costs from their core model. So
I wonder if there's an element. I wonder if there's an element there that's taking advantage of their Amazon Retail Media Network. Hey, maybe we'll just spend money with Amazon advertising instead of spending it with the platforms. What do you think of that idea?
I think that's likely part of it. I think everybody, not everybody, but a large number of companies that have really struggled to get their cost of customer acquisition and just general marketing costs in line as they grow are experimenting with different ways. So a lot of these disruptor brands that we've talked about a million times now and are part of the predictions about some of their struggles, are just experimenting with different ways to change the equation. So in some cases, that's wholesale, more traditional wholesale distribution. Online, I guess, selling through Amazon is another way of a different kind of wholesale distribution. But yeah, they also have the ability to market and advertise in a different way. So, whether this turns out to be savvy strategy or sort of a last gasp of desperation, I guess we'll have a clearer idea about that as the year goes on.
All right. Well, that's a wrap on the news of the week. Now, just before we get to the back half of the prediction episode, let's hear from our presenting sponsor, Marketile.
Marketile is an easy-to-use testing platform and emboldens great decisions, leading to reliable, scalable results. With Marketile, you can be confident in the outcome of your in-store pilot initiatives before rolling them out across your fleet. In a challenging retail climate of supply chain disruption, labor shortages, and dynamic customer behavior, the need for reliable insights has never been greater. Validate your remarkable ideas with Marketile's in-store testing solution. The proof is in the testing. Learn more at marketile.com. That's marketile.com.
Number 7, the hybridization of retail steals the crown from omni-channel. Now, you mentioned omni-channel when we were talking about retail media networks, and we're trying to figure it out, and we've talked about hybridization, but tell me how it's found its way into your prediction.
And this may be more hope than prediction. I just want to put a stake in omni-channel because I just, hate the notion of channels and this idea that it's about being everywhere. But I hope, and I think what needs to happen is the conversation needs to be much more about the blending and the hybrid nature of retail, whether we're talking about the overall shopping experience, the blend of digital and physical, whether we're talking about how supply chains work, like the way Target has pieced together this supply chain, leveraging both stores and direct to take care of the customer in the speediest, most cost-efficient way, or whether we're talking about the go-to-market strategies of having smaller stores with destination stores and all these kinds of things. I think those go-to-market strategies and the way you take care of the customer in a harmonized or hybridized way is really most important. And it's less about trying to be kind of a little bit of everything to everybody everywhere and getting hung up on that kind of channel lingo. So again, maybe a little bit more hope. But I have actually started to see more people kind of challenge the shortcomings of omnichannel more recently, as well as more people talking about blended commerce or hybrid commerce or what have you. So we shall see.
Number 8, trading down will largely define the year.
Yeah, there's kind of two things here. I mean, we have seen hyper growth, both in terms of overall sales, but also store openings in the value segment. So I expect that to continue. I'm not as optimistic about luxury doing especially well, unless you're talking about luxury brands in China. But sort of the global luxury market, I think, is not going to perform especially well this year. I know that's a little bit of counter narrative to some people who believe that it will. So that's kind of embedded within this prediction. So I think when we look at the best performing sectors, both in terms of market share and profits, and I guess ultimately stock price, though I'm not trying to predict stocks here, I think value retailers across the board, whether it's dollar stores, discount mass merchants, the Trader Joe's of the world, et cetera, will perform really strong. But I think the other thing is within retailers that private brands will perform disproportionately well compared to national brands, with the basic premise that private brands offer more value for the money than those national brands. So as customers become more challenged economically, inflation continues to be an issue, they will choose private brands more so than national brands.
Okay.
So sort of trading down to format as well as trading down within format.
Let's talk about troubles emerging in consumer credit. So I guess that connected to the buy now, pay never phenomenon. What is that all about?
Well, originally, and this is where I'm like hedging my bets because I can go back and like if I'm wrong, I can say, well, I didn't really lead with it. And if I'm right, I can say, well, I kind of buried the lead. Originally, this was going to be titled Buy Now, Pay Later Blows Up or something like that, which is part of it. I do think we will see considerable trouble in the buy now, pay later space sometime during the course of the year. I also think when we talk about more traditional credit, that we will see troubles emerge there as well. The way we'll tell that is happening is when the big credit card providers or the consumer credit card providers, any kind of consumer finance providers, I guess more broadly, start raising their loss provisions, and not to get too into the weeds here, but their loss and write down rates will start to go up considerably, and usually that leads to restriction of consumer credit, which is generally not so great for spending. So this is where these troubles could not only affect the particular companies that are in the business of lending money and they don't get paid, they don't make money, but it also could lead to a more restrictive credit environment, which generally will, revert back to people's ability to spend. So I think this is probably more a second half of the year phenomenon, but I definitely think we're going to see some serious troubles here, probably most notably with the buy now, pay later guys, because they have, their whole business model kind of riding on this all working out.
Number 10, strong balance sheets reign supreme. Now, you're not talking here about consumers. You're talking about retailers. Why do you think it's so important this year of all years?
Well, I think in general, and this is not a great thing necessarily, is that the strong get stronger and the weak get weaker. I think it's going to be particularly important this year because the broader market gets, as the broader market gets challenged, the weaker players tend to get more conservative, or in some cases, if they really have weak balance sheets, they have to lay off people, and that generally doesn't lend to market share gains and so forth. So I think it's really an opportunity for the strong players, both in terms of their business model, but their financial capabilities, to really double down on their strategies. This is the time to maybe make that strategic acquisition. This is the time to open more stores, or invest in the stores you have, or invest in new technologies, invest in those experimental programs that may turn out to not pay dividends this year or next year, but will pay dividends over time, whereas the other players will not be in a position to invest for the long term. So I think we will see the big strong players just really extend their leads.
Yeah, and I think that extends, so to speak, as well to real estate. If you're interested in buying real estate, maybe that's warehouse real estate, maybe that's store real estate, that there's some deals to be had for those with a strong balance sheet, right? And while others flee, others will run into that and get some great deals.
It's taking advantage of, buy or sell pricing. Yeah.
Yep. The metaverse. The metaverse still not ready for its close-up. I have my own thoughts about the metaverse, but what are you thinking about?
Well, yours might be more interesting than mine. I mean, I think, the metaverse activity and experimentation and a few high profile, I guess, proofs of concept will continue. So I'm not suggesting what is it called in the Gartner hype cycle, the trough of disillusionment or something like that. I don't think we're going to be going backwards, but I think if you try to get your head around what is really the problem that is being solved by most of these metaverse experiments, it's kind of hard to come up with what big problem they're really solving. And at the same time, consumers do not seem to be significantly increasing their interest. There are a bunch of studies about, what percent of people are even aware of the metaverse or a particular application, what percent of people own a, virtual reality headset. Answer nobody. And so there's a lot of the foundational pieces that are not in place and are, I think, very unlikely to change so significantly that the metaverse will be an interesting revenue opportunity this year.
Yeah.
But what do you think?
Yeah. Or never. I think it's a hustle. I think the metaverse is succeeded for one company wildly beyond its dreams of reframing some problematic issues. I do think beyond that, there's a small niche. I mean, I'm not, and I say a hustle at this large scale that we're talking about, that we're even talking about it in the kind of retail for most retailers. I mean, Apple's going to come out with their own device probably, though it'll be priced premium, I'm sure. $10 billion put in by one company is going to generate something. But, I know there's a lot of people having conferences and meetings with retailers saying, let's talk about your metaverse strategy, which I think they're just bored of talking about supply chain strategies because it's boring. So I call me a metaverse
skeptic. Metaverse, what I have to say about the metaverse.
That sounds familiar.
Well, let's talk about something I'm more positive about. Let's talk about AI. You're number 12. AI, on the other hand, compared to the metaverse.
Yeah, well, I think in terms of the new applications of AI and machine learning, I don't know that I could argue that the business cases will be, or the revenues will be as obvious or more, significant compared to the metaverse. But I think the possibilities beyond some of the things that are already going on from AI, it's just way more interesting. Here there's, acronym soup here, but, ChatGPT, GPT-3, GPT-4, companies like Stable Diffusion. There's so many companies that are attracting a lot of venture capital, a lot of interest, and the ability to replace basically other systems or humans performing functions at a much lower cost, and in some cases, much greater efficacy is tremendous. Those are real business cases to me, because we know that labor looks, at least for the foreseeable future, to be in short supply. The ability to deal with mountains of data quickly, we know that's incredibly, that's got all sorts of different applications. Artistic renderings that can be done. I'm sure some people have seen some of these apps and whatnot. And, we are just in the early days. So I think the level of interest in this and the business cases that are solving real problems that are big dollar problems are already much more apparent in many cases than the metaverse opportunity. But I certainly think in the next year, it's just going to explode. And so I think it's way more interesting, at least in the next couple of years, than the metaverse.
As a group of one, I've actually been using ChatGPT. I've been using ChatGPT to write the introductory comments for some of my podcasts. And it's remarkable.
Pioneer. I think I was talking to, like, you weren't a real person.
And it actually is pretty good.
They can't quite get the Canadian accent right, though. They can't quite get it right. No.
But you know what it is, as a comic in all seriousness, is, if you write it, this as a writer, sometimes when you write, you start using the same words and the same phrases, and it takes a lot of work to break out of that, and that's what I've been using it for, is to kind of help me break out of saying on this episode, those kind of repeatable things. So as a very micro example, it's kind of interesting. All right, well, that's 12. That's your dozen. Let's talk about a bit of a baker's dozen bonuses. Now, you've got a couple of long shot kind of bonuses that you want to share.
First is Nike buys Peloton.
Everything in threes, by the way. I like that.
Yeah, that's right. There's always three, even if I don't know what the third is yet. There'll be one by the time I get there. But Nike buys Peloton. I think Nike, looking for growth vehicles. They're investing a lot in kind of this membership-based platform. Obviously, they're in the fitness business. Peloton needs a lot of help, so they could probably pick it up for a very attractive price. So that would be one. Yep. Second, related to one of my other predictions in terms of big things happening, is that Amazon unloads Whole Foods. Either they spin it out. I don't think they would shut it down, because I think there's too much, underlying value there. But that they have owned it for a long time. It has gone nowhere. There is some new leadership there, so perhaps Jason, I think is his name, will come up with a better plan. But Whole Foods really needs to happen big there, and I think Amazon might, in the Jassy era, give up on it.
It's wholesale changes.
Wholesale changes at Whole Foods. Yeah, that needed a better title. Sorry. If had I used chat. Anyway. And the last one, which, is not a totally original idea, but is an idea that kind of died, but that Kohl's and Penny's merge.
Oh, interesting.
Which I don't think is a great idea, because a mediocre brand with a lousy brand does not equal a remarkable brand.
Yeah. Yeah.
But I think that the pressure on the owners of Penny's, that heat is going to rise, and Kohl's is very much in trouble. And I think they may pull a Sears and Kmart. And what could go wrong?
Well, it's funny that you say that, because, of course, there's a direct pipeline. The two of them, the two leaders, both worked for Levi Strauss. So maybe they at the Christmas party and they can get together and hey, we work together at Levi's. Maybe we can make it happen here. Anyway.
Stranger things have happened.
Stranger things have happened, and I'm sure strange things are gonna happen this year. Love the predictions, 1 through 12 with a few baker's dozen extras. Great episode, and reminder to all the listeners that we will be revisiting these and scoring you and scoring us, mostly scoring you on how you did. So we do hold ourselves accountable, and we do like to come back and chat about these. So we be coming back. For now, let's leave it there, and we'll see you on our next episode. If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Organized for Growth, our interview with Satish Mahatra, CEO of The Container Store. New episodes of Season 6 presented for another season by our friends at Marketal will show up each and every Tuesday. And be sure and tell all your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at StephenPDennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can catch up with Steve and I in person at Shop Talk in Vegas, March 26th, and a month later in Barcelona at the World Retail Congress, April 25th. Until then, safe travels, everyone.